Now, I'm very pleased to welcome Yu Hu, Senior Analyst Energy Chemical Industry from Crude Oil Futures, who's going to talk to us a bit more about crude oil futures in China. Welcome, Yu.
Ladies and gentlemen, good afternoon. I am the analyst of Crude Oil Futures attached to Jiangxi Cooper Group, and I'm very grateful to have the opportunity to communicate with everyone here face to face. And the title of my speech is the Chinese Crude Oil Futures Introduction and Application. With the subject of Chinese crude oil futures, 3 topics are included. The first part is the introduction of the SC crude oil futures, and the second part is the logic of arbitrage of INE crude oil futures, and the third part is analyzing the significance of the renminbi-backed crude oil futures. So let's move on to the first part. After years of preparation, China's crude oil futures is finally launched in Shanghai International Energy Exchange on 26 March. The crude oil futures is designed as international platform and net price trading and bonded delivery and RMB denomination. So both overseas traders and brokerage firms are able to participate in this trading. By 20 April, the daily trading volume of the INE crude oil futures had attained 63,000 lot, exceeding the number of Oman crude oil futures in DME, so it has become the most active crude oil futures in Asia. Now, to present the similarity and differences between INE crude oil futures and the other foreign crude oil futures, I have selected 3 crude oil futures contracts for comparison, including Brent, WTI, and Oman. The reason was as follows. Brent and WTI are the global crude oil futures with the largest trading volume, and they are the most important oil benchmark. Although the trading scale of DME Oman is not quite large, but it is the reference of the official price. Apart from that, it also has the same crude oil accepted for delivery as the INE crude oil futures. So firstly, let's compare the qualities of the Ford oil. It could be found that WTI and Brent are both the light sweet crude oil future, and the Oman and SC are both the medium sulfur crude oil. So why does China choose the latter as the standard quality? We have 2 main reasons. From the perspective of the global output of different types of crude oil, the proportion of medium sulfur crude oil is 14%. And furthermore, in terms of import feature of China and other Asia, the imported crude oil of China is mainly from Russia and Saudi and Oman and Iraq and so on, where the quality of the major crude oil is medium sulfur. And in terms of producer, the crude oil imported from the Middle East account for over 49% of total amount of import of China. In terms of oil spices, The proportion of middle sulfur crude oil future reached 16%. And what's more, the quality of Shenli oil is also the medium sulfur crude oil. As for the trading margin, the margin of INE crude oil future contract is 7%, while the other three crude oil futures adopt both the initial margin and position margins. So if conversed with the latest margin, then the margins are about 4.3%, 4.6%, and 5% respectively. Apart from that, the details are as follows. The margin is 7% from the date when the contracts are listed, and the margin is raised to 10% and 20% as time goes on. So if we estimate with the margin of 7%, and then one bought a lot of INE crude oil future contract requires about 29,000 yuan per barrel, while covered with the exchange rate of 6.3, the margin are about 16%, 16,000, 22,000, and 22,000 yuan per barrel for WTI, Brent, and Oman. So therefore, the margin of China crude oil futures is slightly larger than that of the other three foreign crude oil futures. In terms of the list contracts, the detail for WTI monthly contracts list for the current years and next 8 current calendar years. Brent includes 96 month contracts and cover 8 years, while Oman contracts cover 6 years. The number of INE crude oil contract is 3 years. Since the INE contract is settled in yuan, the minimum price is adapted to 0.1 yuan per barrel, and is different from that of $0.01 per barrel for foreign crude oil futures. Judging from the daily price limited system, WTI adopts the circuit breaker of $10 per barrel. On the other hand, there is no price limited system for Brent and Oman. The INE has set up the price limited of up and down 5%, and if calculate with $16.5, the limitation for price are up and down $3.25. In other words, the price limitation for SC crude oil futures is smaller than that of foreign contracts. On the other hand, the trading time lasts almost 24 hours in foreign crude oil futures market, while in China, the trading time of INE crude oil futures is the same with current other futures in Chinese market, and thus the continuity is weaker than the foreign future contracts, considering the factors of trading time and price limitation. Investors could use foreign future contracts to hedge the risks. As stipulated by INE, the last trading day of SC crude oil futures is last trading day of the month before the delivery month. Taking 1809, for example, the future contracts whose last trading day comes first are Brent and Oman, of which the last trading day is the last trading day of the second month before the delivery month. And then is WTI and SC. It is noteworthy that for those who do not choose delivery, INE requests them to ensure their positions should be zero after the market closes on the 8th trading day before the last trading day. And thus, the natural person clients have the similar date of last trading day with WTI. Apart from that, SC crude oil futures are first futures prices in China opened to the foreign investors, and next I'm going to briefly introduce it. There are three approaches for foreign investors to participate in crude oil futures trading as follows. The first way is to directly become the OSMBP of INE, and the second way is where the OSBP. The third way is participate trading China future firm members. If foreign investors are familiar with some financial institutions in overseas markets, which are not the foreign special broker participants, then the investors could cooperate with these institutions and participate the SC crude oil future trading through the OSBP or the China future firm members. After comparing the INE and foreign crude oil futures contracts and introducing the trading rules, let's move on to the second part, the application of SC crude oil futures and on arbitrage. In crude oil market, the main arbitrage methods include intermarket arbitrage, time spread arbitrage, and crash spread arbitrage. The details are as follows. Intermarket arbitrage is generated from the differences between demand and supply in different regions with various standard prices. For example, when the output of shale oil is rapidly increasing and the export of crude oil is prohibited in America in early years, or recently in the Permian areas was once stuck with the pipeline transportation problems. The spread between WTI and Brent has widened. However, the region of the ban on crude oil export and the transport program reliefs in Permian areas, the spread could entirely cover the arbitrage cost between these two regions, leading to the fallback of expanded spread. Therefore, when applying the intermarket arbitrage, except considering the quality differences of the oil, it is more required to consider the differences between the demand and supply in regions as well as the transport cost. If applying intermarket arbitrage with SC and Oman, of which the quality difference is small, the main fact to be considered is whether the spread could cover the spread could cover the arbitrage cost. After calculating for short position, when the premium of Oman to SC is over $3.2 per barrel, the arbitrage opportunity would appear, and the top and down frontiers of arbitrage are $2 and minus $1.5. The reason why the arbitrage scope for long position is quite large is that the possible interchange cost result from the uncertain of delivery reliability. Investors could remind that though the DME Oman crude oil is good underlying oil spices for arbitrage, the relatively small trading volumes might cause the liquidity risk. Therefore, except DME Oman, Brent Dubai swap and the other approaches can also be used to seek for intermarket arbitrage opportunities between Brent and SC crude oil futures. The main logic for this are the demand and supply differences between the medium and sweet crude oils, and as well as Asia and global. However, because the delivery method of Brent is cash settlement, this arbitrage logic might not be appropriate to apply until SC crude oil futures market become mature. In terms of time spread arbitrage, the former curve are affected by storage cost, financial cost. The difference is between the expectations of demand and supply in near and front ends, and so on. If taking the storage cost and the others as the proper spread, when the near-term fundamentals is poorer than that of the forward term, and the intermonth spread is larger than the proper spread, the distinct contango structure is then formed. As a result, the market would be attracted to start storing the oil, removing the near-term surplus, which could therefore lead to the spread structure return. By contrast, when the near-term fundamentals are better, the forward curve would gradually become flat and even turn into backwardation structure. In this case, it is not profitable to store oil, and thus the market tends to sell out the inventory, making the spread back to its equilibrium level. However, the process as mentioned above, deeply influenced by the expansion of market in practice. Taking WTI's example, on 22 September 2017, the agreement under the situation that the product limited agreement of OPEC is conducted well, and the agreement would be further enhanced. The first complete backwardation structure appears in WTI market, and such structure has maintained to now. The production limit agreement between OPEC and non-OPEC adopt a phasor-based reduction mode, and that is the and that is the agreement would be extended for about 6 months at each meeting. Therefore, the market is concerned with whether the agreement would be suspended or weakened after the time point, causing the backwardation structure. Therefore, under the background of production limit agreement, the crude oil market has been in the consumption seasons for destocking. However, the uncertainty of agreement could lead to the risk of return productions after June, and thus the backwardation structure of the oil price is expected to continue. But because the forward contracts are quite short of liquidity, the SC crude oil futures have not formed a complete forward structure. For the perspective of the increasing activity of SC crude oil futures based on the logic of the formation of backwardation structure, it is practical to attempt to long near months contracts and short the forward months contracts. And for crack spread arbitrage in the crude oil futures market, the crack spread arbitrage is commonly applied with CRK 3-1, CRK 5-3-2, and so on. Cross species arbitrage is of great seasoning, and spread would return to a high level before the consumption seasons come. However, the lack of refined oil futures and incompleted market pricing mechanism, it is difficult to apply the crack spread arbitrage with SC crude oil futures. The current future spices, in the current future spices, the price of bitumen, which is the direct product of crude oil, is highly correlated with the price of crude oil, since bitumen is now the main product of crude oil. So the demand is now determined by that of bitumen as a significant factor after affecting the spread. The divergence between the demand and supply might occur. So after the application of SC in arbitrage, let's move on to the last part. There are 4 major implications of China to launch the INE crude oil futures contracts. Firstly, it is convenient for a large number of Chinese enterprise to use hedging of INE crude oil futures contracts to manage risks and keep the valuable investors' resources in China. Secondly, the center of gravity of global energy economy has shifted. Both the demand and trade have shifted from the Atlantic basin to the Pacific. 15 years ago, Asia countries accounted for 1/8 of oil consumption. However, last year it became 1/3, with most growth met by import. So we need a new oil future contract to be the oil benchmark of Asia, which will satisfy the requirement of China and Asian market. Thirdly, it is the first Chinese futures product which can be traded by foreigners without a presence in China, though trade with the settled in Chinese currency. It will be conducive to the internationalization of the RMB. Finally, China is the world's biggest consumer of raw materials, and now we face an opportunity to become the global price-setting center for commodities. So China will make use of experience in crude oil market with iron ore and natural rubber on the way. To open the domestic market to more foreign investors, but we know that to build a crude oil futures market is a complicated and long-term systematic project. 20 million barrels of crude oil change hands on average each day in INE just represent 3% of total volume of WTI and Brent. Moreover, different from other markets, so far the trading in INE has become concentrated only in the front month contract. Furthermore, the volumes on the bourse were more than 4 times of DME Oman crude oil contract, while the open interest presence is in the opposite way. So, according to all of these problems, before we're talking about whether the INE crude oil futures will break the dollar's stranglehold on the global financial system, the matter we should focus on is when the INE crude oil futures will become a major financial product. That's all for my presentation. Thanks for listening.